Gold prices have shot up this year, and if you have missed the bus, you probably are wondering whether you should buy it or not. Experts are sending mixed signals right now. Some saying gold still has a lot of horsepower left. Others are saying it has already reached its peak, a bubble has built up, and it will only go down from here. But there is a crucial secret behind this surge in gold prices which no one is telling you. Over the next few minutes, I am going to uncover that secret that all the people with money and power know, so that you too are armed with that same knowledge. So let us start with the first, most obvious question. Why do we humans have this obsession with gold? How can something which virtually has no productive use have such immense value to us? The most important, or the first reason, and this surprised me when I found that out, is that it reminds us of water. Strange, isn't that? Well, that's what researchers in two separate studies concluded, that we like shiny objects because it is naturally tied to our primordial search for clean water for survival. That is why historically humans have sought out shiny things. Not just gold, but silver, diamonds, other precious stones, even when they didn't consider them to have any economic value, remember. But as societies became more organized, trade developed, and people started to convert their income into wealth and store it, gold and silver became especially valuable. It could be stored forever, and it is also one of the softest metals in the world. It ranks 2.5 on the Mohs hardness scale, where iron scores 4.5 and diamond, the hardest material, scores a full 10. This softness makes gold especially malleable. 1 ounce of gold can be beaten into a sheet that will cover the floor of a 15 by 20 foot room. So it attracted people because of its shine, and it was easy to beat into ornaments. That, however, tells us nothing about its economic value, because after all, even aluminum foil is shiny, can be easily molded into different shapes, but that doesn't make it valuable, right? We don't store our wealth in aluminum foil. Gold's value actually comes from its scarcity and the extreme hard labor that is required to mine it. Now imagine this, that a farmer takes 6 months to grow 100 quintals of wheat, and a gold miner can only extract 20 grams of gold in that same period. Then the value of each gram of gold would be equal to 100 divided by 20, or 5 quintals of wheat. Now hypothetically, anything can be used as money, and it has been in the past. For instance, salt bars were used in Ethiopia as money, dog teeth were used in the Solomon Islands. Even wheat can be used as money, and we know that sometimes even now, workers in villages are partly paid in wheat for their labor. Now 100 quintals of wheat might be exchanged for 20 grams of gold in a market, but 20 grams of gold can be stored forever, but wheat will go bad pretty fast. 20 grams of gold can be put away in a small bag in your locker at home or in the bank. 100 quintals of wheat will require you to rent a warehouse. And if you want to last for even 8 to 10 years, you would have to spend quite a bit for maintaining great storage conditions. So you can see that it is actually all these qualities of gold that make it an ideal form of money. It is easy to shape, lasts forever, and a very small amount has huge value. By the way, just to let you know, I haven't picked out these numbers arbitrarily. The minimum support price for 100 quintals of wheat right now is roughly the same as the market price of 20 grams of pure gold in India. So don't make the mistake of thinking that gold has no innate or intrinsic value. It does. Just like any other commodity, its inherent value comes from the amount of work required to produce it, to extract it. But gold wasn't the only metal that was used as money. Silver, as you know, was also a strong contender, and was that through history, even though it was easier to produce and therefore had lesser value. An error, or some say a deliberate move by this man, Sir Isaac Newton, who you know better for defining gravity, changed the relationship between gold and silver forever. In 1717, Newton was in charge of the British Royal Mint, and his task was to decide the price of gold vis-a-vis that of silver. He calculated how much gold cost in other European nations, but ended up fixing a price which overvalued gold in Britain by almost 3%. This turned out to be easy money for merchants. They bought gold in France and Holland, where it was cheaper, and brought it to England, where it fetched a higher price. Now, remember that this was the period of the rise of the English East India Company and the quest to capture the world's trade and colonize countries. Since gold became the most precious and valuable metal in England, it gradually became the most valuable metal across the world. Newton's era opened the path to the gold standard, where the value of a currency was pegged to a particular amount of gold. Britain was the first to formally adopt it in 1819 and then gradually implemented it across half the world, which it had colonized. Other countries also followed suit pretty soon. The gold standard had to be abandoned during the Great Depression, but it made a comeback in a roundabout fashion towards the end of the Second World War in July 1944. That's when representatives of 44 countries congregated at a hotel in the secluded foothills of Bretton Woods in New Hampshire to thrash out the rules for a stable global monetary system in the post-war world. Although 44 countries participated, the real power was held by the United States, which by then was the richest nation and the only big economy that had not been devastated by the war. It was decided that only the US dollar would henceforth be pegged to gold. The price of 1 troy ounce of gold, roughly 31 grams, was fixed as 35 American dollars. And every other currency was now going to be pegged to the dollar. This was because in 1944, the United States alone held 57% of the world's gold reserves. This single move made the US dollar the world's reserve currency. So America's role as the international big brother is one of the most important aspects of the secret history of our obsession with gold. But it would only make sense if the US restricted the total amount of dollars it was printing, right, to the actual physical quantity of gold it held in reserve, because there was a fixed exchange rate for gold. That is not what actually happened. As the economy grew, US economy grew, it started importing a lot of foreign goods. Now, theoretically, under the Bretton Woods system, the USA's own dollar reserves should have depleted, since the total amount of dollars was technically pegged to the gold in its reserves, right? We can understand this using a highly simplified example, okay? Imagine that the USA had $1,000 in total and American consumers decided to import $100 worth of wine from France. The French National Bank has $100 more now, while American banks are down by $100. Now imagine that a total of 1,000 units of goods were produced in the USA that year, and there were, as we said, $1,000 available to spend on them. The average price of each product, remember this is a highly simplified example, that average product price would be $1,000 divided by 1,000 units, or $1 each. But remember that Americans have sent $100 abroad to buy French wine. So now what happens? There is still those 1,000 units of products in the US economy, but the money inside the USA has shrunk to $900. Now the average price of each product in our highly simplified example is just 99 cents. Prices have dropped by 1%. In other words, the US would see deflation take place. Now, you might think that prices going down is good for you, right? Because things are becoming cheaper. But that's because you're only thinking of it from the perspective of a consumer. Think like a business owner now. Any fall in prices is also a fall in your revenues. And the only way for you to maintain your profit margin is to cut salaries and wages in the same proportion as the fall in your revenues. Now put yourself back in the shoes of an employee. Your salary has been cut, right? When salary cuts take place, and it is happening quite a lot now, we don't look at prices and say, oh, it doesn't really matter, because prices have also gone down, so I can buy the same things that I could with my old salary. We don't think like that psychologically. Instead, we say, oh dear, I need to save, I'd better not spend. We also tell our spouse, let's not buy that new TV this month. Prices are falling every day. Let's wait for a couple of months and I'm sure it will get cheaper. Now think of all consumers like you. Everyone is postponing their spending. So businesses suddenly see the demand for their products drop. They react by reducing their output, and since they don't need to produce as much, they don't need as many workers. So guess what? Your job is suddenly on the line because you bought French wine. Of course, US policymakers knew this very well, so they offset the outgo of dollars by printing more dollars. In fact, this increased even more during the Korean War in the early 1950s, when the US began spending heavily on the war. To finance that, they printed even more dollars. As soon as the Korean War ended, the Vietnam War began. Again, the US printed a lot of dollars to finance it. Now imagine you are France. Your currency back then is pegged to the dollar at a fixed exchange rate. Dollars are flooding in around you because Americans are buying your wine, and also from Vietnam, which was once your colony till right before the war began. Since the exchange rate is fixed, you have to print more francs to meet the influx of dollars into your reserves. Now, there is more francs chasing the same amounts of goods in your economy. In fact, probably lesser because the USA is buying up your wine. More money, fewer goods. What does that cause? Inflation. Exactly. By the way, this is not just a hypothetical example. Something like this really happened in France in the late 1950s and early 1960s. The average inflation in France between 1952 to 1956 was less than 1%. Between 1957 and 1963, that rose to an average of 6%. The French were getting pretty annoyed with the Americans. The US could print as many dollars as it wanted, ignoring the gold standard it had committed to, but France had to match any additional US dollar supply by increasing the amount of francs it had in circulation, because the French currency was fixed to the US dollar. This was true for all countries. Charles de Gaulle, hero of World War II, who returned to politics in the late 1950s, was one of the first to call out this unfair system. He argued that the US was keeping its citizens happy, expanding its influence through wars across the globe by printing far too many dollars, and effectively the US was exporting inflation to the rest of the world. So in February 1965, de Gaulle announced that the French central bank would convert $300 million into actual gold, the dollars that had come into into France from the US. In fact, this was just the final act in a secret operation that de Gaulle had launched 2 years earlier, which was named vide-gousset, or empty pocket. De Gaulle was trying to empty out the pockets of the US Federal Reserve and the Bank of England, where all the gold was stored, by gradually exchanging the dollars that the France had got for real gold. The operation, which began in 1963 and continued till 1966, involved 44 boat trips and 129 flights to bring back 3,300 tons of France's gold back to its own vaults. France's action encouraged others to do the same. Everyone realized that the dollar was actually overvalued. If 1 troy ounce of gold was fixed at $35, then seen from the other side, $1 in value was equal to 0.9 grams of gold. But since the US had printed a larger amount of dollars, the real value of a dollar was actually much lower. So the US was effectively keeping the dollar artificially overvalued in terms of gold. Every country realized that this dollar bubble was going to burst at some point. So they rushed to convert their dollar reserves into gold and take it back home. By mid-1971, even America's greatest ally, Britain, wanted to convert its dollars into gold. In fact, between 1961 and 1971, US gold reserves fell by almost 35%. That's when Richard Nixon, the notorious Watergate president, gave the world what has come to be known as the Nixon shock. On 15th August 1971, Nixon unilaterally suspended gold convertibility. Nations could no longer turn up at the US Federal Reserve and ask for gold at the fixed rate of $35 to an ounce. Now, as the dollar floated free and adjusted to its real value, gold prices shot up. Between August 1971, the time of the Nixon shock, to August 1978, the price of gold rose from $35 to an ounce to an incredible $210. That is a 5-fold increase in 7 years. But this was just the beginning of what was to come. It had to do with this man, Shah Reza Pahlavi, the US-backed autocratic ruler of Iran. At that time, Iran was the second largest producer of oil after Saudi Arabia, and no country was more dependent on it than the USA. Americans, after all, owned 40% of the world's passenger cars, so they needed fuel to run them. Throughout 1978, Iran was in great turmoil. Oil company workers went on strike, causing huge supply disruptions, but the Shah ensured that his friend, the US, got enough petroleum. So US consumers were not affected that much in 1978. But from January 1979, the mood began to change on the street. Protests intensified, calling for a regime change in Iran. The Shah fled, and Ayatollah Khomeini, the exiled Shia cleric who was the face of Iran's Islamic Revolution, returned to Tehran. In those tumultuous days, Iran's oil production dropped sharply from 5.8 million barrels a day in July 1978 to just 0.4 million barrels in January 1979. Basically, the Iranian Revolution took out 7% of the world's oil supplies. The result was a massive rise in gasoline or petrol prices in the US. This graph will tell you how petrol prices in the USA shot up by 50% over 1979. That pulled inflation up sharply as well. And as inflation rose, the value of the dollar fell against other major currencies. By January 1980, the dollar had weakened by 12% compared to where it was 2 years earlier. And as the dollar weakened, obviously, the price of gold in dollars went up as well. The biggest surge came in the last 2 months, from November 1979 to January 1980, when the price of gold doubled. But this last surge wasn't just because of inflation or a weaker dollar. Two major historical events triggered this panic buying of gold. The first was the Iran hostage crisis, where 66 Americans were held hostage in the US Embassy in Tehran on the 4th of November 1979. And the second, probably bigger trigger happened the very next month when the Soviet Union invaded Afghanistan. By January 1980, gold prices had risen to a peak of $850 for an ounce. Remember that it used to be $35 till August 1971. So if some rich person had bought gold worth 1 lakh rupees in August 1971, they could have sold it for 24 lakhs in January 1980. But then came the Volcker shock. Paul Volcker, who had taken over as chairman of the US Federal Reserve, which is the central bank, in August 1979, had already started raising interest rates even before the final gold price surge took place. Throughout 1980 and 1981, Volcker would keep raising rates to rein in inflation, with rates peaking in June 1981 when it hit 20%. We can't even imagine that nowadays. Along with that, in March 1980, the outgoing US President Jimmy Carter imposed strict credit controls, making it much tougher to borrow for businesses and households, and most importantly, for speculators. So two things happened. It became tougher to borrow and bet on gold, and second, high interest rates made bank deposits much more attractive again. Both of these had a dampening effect on gold prices, and they collapsed. Although Ronald Reagan, the new president who replaced Jimmy Carter, withdrew the credit controls in May 1980, he backed Volcker's plan to keep raising interest rates. High interest rates in the US meant investors from across the world flocked to buy US dollars again, and the dollar began to strengthen. Between January 1980 and December 1984, the dollar gained 39% against major currencies. The exact opposite happened to gold. It collapsed completely, losing a massive 63% in that time. Gold prices would take another 28 years to go back to the peak it hit in January 1980. So let us come to now. Gold, as we all know, has risen to record levels, going up by 66% in the past 11 months alone and 31% in just 3 months. And again, the exact opposite has happened to the dollar, which has lost 8% against major currencies since the beginning of this year. So what has caused this? The immediate trigger clearly is Donald Trump, whose aggressive and unpredictable tariff policies are causing massive global uncertainties among people with money. So they are buying gold as a safe haven investment. Trump's policies have basically put a question mark on whether the US dollar will remain the global reserve currency in the coming years. Because if the US restricts trade, then it makes no sense for the rest of the world to trade among themselves in US dollars, right? That's another reason why big investors and speculators are selling dollars and moving into gold. But a large part of the recent demand for gold has actually come from central banks. And the reason for that goes beyond Trump to Vladimir Putin. When Putin invaded Ukraine, the West froze all of Russia's foreign exchange reserves that were lying locked up in Western bonds and dollar-denominated instruments. Every nation learned its lesson from this. And central banks have been quietly buying up gold and moving it into their vaults ever since. Take the RBI, for instance. It has increased its gold purchases significantly since last year and sold dollar-based investments and moved into gold. In fact, in September 2024, gold accounted for 9.3% of our total forex reserves. In September 2025, that has gone up to 13.6%. And of course, there is the FOMO, or fear of missing out, of those who didn't get into gold early. They're rushing to buy gold when it has already risen up and almost peaked, pushing up prices even further. So what are the experts saying about the future of gold price? First, those who think that this is a massive bubble and it is going to collapse any moment. The cost of producing gold, an extra ounce of gold right now, is estimated to be about $1,600. What is called all-in sustaining cost basis, which includes all possible long-term costs of producing gold, including mine rehabilitation and environmental compliance costs. Something that costs $1,600 to make reached a peak of $4,382 in October 2025. So theoretically, a gold mining company can make a profit margin of 175% by selling gold right now. Of course, gold's pricing is not like other commodities, but still many analysts believe that such a high gap between the cost of producing gold and its market price is unsustainable, because otherwise every company in the world with extra cash would want to get into gold mining, right? The second big reason is the price level itself. In 1980, gold hit a peak of $850 to an ounce. Adjusted for inflation in today's dollars, that is equal to about $3,500. So in real inflation adjusted terms, the current peak is 25% higher than the highest it had reached during the gold bubble of 1979-80. But this is where the gold optimists come in with their counter arguments. They say that in the 1980s, the USA was emerging from deep stagflation, and the neoliberal policies that Reagan unleashed and exported to the rest of the world re-established the global dominance of the dollar. American money traveled the world looking for opportunities to invest, and that made dollars much more attractive than gold. Right? In fact, gold, as Warren Buffett once said, is an unprocreative asset. Unlike land on which you can grow crops, factories in which you can produce goods, and even cash itself which can be lent against interest, gold gives no returns other than the change in its value. So as long as the global economy was expanding, as long as there were opportunities to invest and make money from production or through financial speculation, gold wasn't worth holding. But now there's only one set of things in which new productive investments are taking place: artificial intelligence, data centers, and chips. Everything else is gradually retreating. And as artificial intelligence threatens to wipe out white-collar jobs, the sense of economic uncertainty is only increasing. Owners of capital have no real reason to invest in regular goods and services anymore, so they might continue to move into an unproductive asset like gold just to hoard their wealth in it. After all, gold has repeatedly withstood the test of time for thousands of years. So what is your view about this? Are you likely to buy gold anymore? Let me know in the comments, and also join the discussion and debate over gold. If you like this video and would like more such research-driven videos, do subscribe to my channel. And if you want to know more about how AI is threatening to destroy white-collar jobs, what I spoke about earlier, then click on the video link on your screen right now.